stay there long term, because the rain that we've had this past year has really just been a downer for me. And to know that those people have it so often, um, I just don't think it's for me. So I'm very happy to be here in Atlanta, Georgia. I'm happy and thankful that you guys are joining me. So this week, I really wanted to dive in because last week, if you kind of noticed, rates went down a little bit. And I think a lot of that just had to do with the fact that we had a bank crash and then the Fed scooped in, and just a lot of things going on. So obviously, when there's a lot of drama going on, rates seem to dip a little bit because there's fear of what is going to happen. However, this week, rates have gone back up. Lovely, just the roller coaster ride of rates over the past 9 months now. So I know a lot of you are like, if they could just stay stable, whether it's at 7% or whether it's at 5%, obviously lower is better. But if it could just stay like where it's like in one place, that would at least give me the opportunity to figure out what can I actually afford. Because when it goes from 5 to 6, from 6 to 6.5, back to 6, now to 7, back to 6, like your affordability is going all over the place, right? Like one minute you can afford one price range, and then the next you can't afford that anymore. You got to go, back over here. So it's very stressful. So what's also stressful is the fact that my screen share ability is not wanting to cooperate with me, because I had all sorts of goodies that I wanted to share with you tonight. So now you're just going to have to read along with me, or actually I'll read it to you, and then I'll put the links below in the chat so that way you can look them up on your own and make sure that you're fact checking me, because I always do that. But it happens, right? I always say technology is great when it works, and for whatever reason, today it doesn't want to. So that's okay. We're going to just roll with it and do the things. So one of the things I wanted to share with you, and if I'm looking off screen, it's because I'm looking at the screen that I was supposed to be sharing with you. So the pace of annual home price gains slow across the US. However, Atlanta continued to see an 8.4% increase. So I found that very interesting. And it says places like San Diego, Seattle, Portland, and San Francisco actually saw negative growth increase. So those places kind of went backwards and saw the reduction in pricing that a lot of people, I think, are anticipating with this market. So it's interesting that it says at a national level, the index rose 3.8% year over year, which is actually a healthy market. Typical market is between 3 and 5%, especially here in Georgia. So rising 3.8% is actually a very, very healthy market. So the fact that nationally, that's kind of what we were seeing, it's right kind of where we should be. Actually, it's ahead of the curve if you want to look at it from the point of we're just through first quarter. So that's really great. But then unfortunately, those couple of cities were seeing a reduction, but Atlanta is showing, in Atlanta, home prices posted an 8.4% year over year gain in January, the third highest increase of the 20 cities in the survey. You also had Miami, you had Tampa, and then Atlanta. So that's great news for Atlanta in the form of we're not seeing declines. We're still seeing equity gains. However, I know for some of you, you're like, yay, my equity went up, and I'm all for that. It still does not help with affordability. And that's something that we're going to really touch on today, because one of the other articles that I was going to share, and again, I'll put those down in the chat. One of the other articles was going to be, we're still in a seller's market. We are 100% still in a seller's market. So I don't know if you tuned into my live video last week, but we kind of talked about what is a seller's market, what is a buyer's market, what is kind of an equal market, which we very rarely see an equal market. Usually when you see an equal market, it is when you're kind of pendulum swinging from a seller's market to a buyer's, or back over from a buyer's to a seller's. And you'll only see that for like a couple of months where everything is perfectly equal and it seems like it's too good to be true. And it is. And then you swing on to the other side. So a buyer's market is when we have more inventory than we have buyers. So for every home that is available currently, we have more buyers than we do houses for sale. When you switch over to a buyer's market, you have more homes for sale than you do have buyers looking for homes. That's when you start to see homes sitting on the market longer. That's when you start seeing more housing reductions. That's when there's 6 months of inventory or more. So in a seller's market, which is what we're in right now, it's if you're at 5 months or less, then you're in a seller's market. Currently, we are only less than 2 months of inventory. And so earlier this year, I'd say January, beginning of February, I was not really seeing multiple offers. When we were seeing homes go on the market, we were seeing them stay on a little bit longer, maybe 15 to 30 days, which again is typical for Georgia. 30 days is a typical length of time to stay on the market. And we were seeing things between 15 to 30 days, not really multiple offers. Very quickly, as our spring market started to come, that changed very quickly, very drastically. And so we started to see these multiple offers again. And again, it's very different than it was in 2021, early 2022. Then we were seeing extremely aggressive, 20 offers, $100,000 over asking price. It was just absolutely insane, waiving all of your contingencies. But we're kind of getting into that, not to that degree, but what we're seeing is multiple offers, maybe 3 to 5. One of them last week, I told you guys I shared, had 11. That was at a more affordable price point. So obviously, again, that just drives the price up, and affordability is not a great option. So what are we to do with that? So if we're looking here, it says, even though activity in the housing market has slowed from the frenzy that we saw over a year ago, today's low supply of homes for sale is still a seller's market, because what is creating the seller's market right now is the lack of inventory. I have a client right now that's visiting from out of town. Her husband got transferred here. They flew in this morning to see 4 houses. We were able to see 1. The other 3 homes have gone under contract since Monday when we talked about them flying in. And so they were able to see 1 of the properties today. Nothing else has come on the market. I do think a lot of that has to do with the fact that next week is spring break, and a lot of times people are gone, so they're not listing. But inventory continues to be an issue. And we're just like in this gridlocked pattern, because the problem is a seller needs to buy something, but there's nothing to buy. Well, then the seller's going to stay put, and the seller's not going to sell that house. Well, that's potential inventory that would have been on the market for another buyer to buy. But if that seller has nowhere to buy, then they're not going to provide another listing for a buyer to buy. It's very gridlocked. It's like we're in Atlanta traffic, right? But we're in the Atlanta traffic housing market. That's literally what we're going through right here. So it starts with the number of homes available for sale. Today, we have a 2.6 month supply. That's national. Historically, a 6-month supply is necessary for a normal or neutral market. That's what we were just talking about. So it's really tough. And I wish you guys could see this slide. God bless this thing. Months of inventory in 2010. So a lot of people think that 2008 was the worst of it. It really wasn't. 2008 was when the crash happened and when a lot of things went down. But in 2008, we had 11 months of inventory. And so we were very much in a buyer's market. That's when buyers were able to get and negotiate on lots of things. But then in 2009, it actually dropped back down to 7 months, and we were in a neutral market. But then in 2010 is kind of when, like, 2008, a lot of people were like, oh crap, the bottom's falling out. And a lot of people ended up filing for foreclosure. A lot of people ended up trying to do short sales, but a lot of people did not see those foreclosures come to fruition, because a lot of people think that when you get foreclosed on or you file for foreclosure, or you get that notice, I shouldn't say you file for it, because you don't file for it. When the bank forecloses on your property, it's not immediate most of the time. In Georgia, they do not have to notify you. They can just file it immediately. We're a non-judicial state. So, but the fact of the matter is, a lot of those people that had a foreclosure notice given to them stayed in those homes for 18 months, 22 months. And they did not really see that come to fruition. So in 2008, when everything, kind of hit the bottom, you didn't actually see that come to fruition and see all of the detriment that was going to happen until about 2 years later in 2010, when that's when a lot of those foreclosures really started to hit the market. The housing inventory was flooded with those short sales that the bank had to take on, with those foreclosures that the bank had to take on. And so when all of those hit the market, if you were trying to sell your home like a traditional sale, God bless your heart, you were having to basically give it away. If you needed to move and sell your home, you were basically giving it away. You probably had no equity in that home, or very, very little, because there was such an enormous amount of foreclosures and short sales that came on the market that the bank had to take over in 2008 and 2009. And so that just completely, it just did damage to anybody that was trying to sell their home in a traditional stance. So a lot of people, if you didn't have to sell, you were not selling. You were holding on to what you had. And going forward, if you, well, can't see it, it started to get better and better. And by, let's see, about 2012 to 2014 is when we started to see things, kind of neutralize and come back to normal. And then shortly after that, we went back into a seller's market. And we've been in a seller's market for quite some time now. So, I mean, it's really about time. Like, if you look at statistics, it really is about time for us to kind of have that pendulum swing. Unfortunately, with rates going all over the place, with the pandemic happening, and not only the pandemic happening, but the pandemic creating building issues by not being able to get supplies here, it just kind of threw off the balance of the real estate market and what we typically see in the real estate market. And so what frustrates me is, I really feel like until Powell starts to see people losing thousands of jobs, they're not going to come back around with decent interest rates. And it's frustrating. The more I've dug into this, the more irritated I get, because it really truly is, they want to see a balance to the market. And the balance to the market is, if the economy is doing well, everybody has a job, or most people have a job, economy is doing well, then we're just going to raise rates because y'all are spending too much. And if the economy is crap and everybody loses their job, then we'll lower rates because, now y'all are having a hard time. So we'll help you out. That just does not make sense. I mean, I get their thought process, but it's very irritating to me, because I feel like when the economy is doing well, everybody has a job. Like, why not continue to have the economy doing well? But I don't want to go political and go financial on you. So just kind of threw my 2 cents in there. Sorry about that. But it is sad, because I think that we're not really going to see a correction as far as rates until we start to see job losses. And I don't know when we're going to see that. I know a lot of people have different theories of what's going to go on this year, but I guess only time will tell. So looking at the pace of income here, or gains, with Atlanta still continuing to gain 8.4% equity, home pricing, that continues to make things unaffordable. So I wanted to share with you guys some of the questions that I get asked a lot these days, especially with first-time home buyers, because with everything being so unaffordable, a lot of times you are banking on the fact of, well, if I'm a first-time home buyer, or even if I'm moving to my next home, you're able to ask for closing costs or ask for, negotiations. And with everything going back into multiple offers, that's really a hard strategy. So the problem with that comes with, if you're not able to ask for closing costs, or you're not able to negotiate, How are you supposed to make this more affordable for you? Right. And so a lot of people have asked, well, what about buyer incentive programs? What about down payment assistance? What about, um, just the different things that a lender could offer or the government offers? Because you hear about them all the time, right? You hear about them constantly. And so the frustrating thing is they never really give you the full scoop of what that looks like, because obviously they want to entice you. It's kind of like, fear tactics. They entice you to listen to things because it's scary. It's what's going to happen. And so you end up listening because of that. This is the same thing. They never truly tell you what all of these are about. And so they entice you with the fact of, oh, there's government assistance, there's down payment assistance. You can absolutely get in on that. That's not always the case, because the problem is they keep raising the limit as far as what you can purchase, which has helped things in a lot of ways. Because the fact of used to, I remember, God, I want to say it was like 10 years ago, in order to do like the conventional cap was at like 400,000, right? Which is crazy to think of now, because your average home price is at like 483,000, I think it is this week. Um, so to do a conventional at 400, like half more than half wouldn't even be able to do a conventional loan. So now the conventional, as of today, it's $726,200. That is the highest that you can go with a conventional loan before you have to consider going to a jumbo loan, or you can put money down and then get into that conventional. If you're buying something, say it's 800,000 and you want to put down, 70 or $80,000, you could then get into that conventional because it caps at $726,200. But so if you're looking to do an FHA program, which is typically for a first-time home buyers program, but you don't have to be a first-time home buyer. A lot of people think that you have to be a first-time home buyer. That's not the case. You are able to use the FHA. A lot of people don't use that because you can do a conventional loan for 5% down. You can do an FHA for 3% down, but there are programs that can get you any conventional loan for 3% down. And with an FHA, their appraisal limits are much more strict. So if a home doesn't have windows, or it doesn't have carpet, or it doesn't have a stove, things like that, the FHA appraisal is not going to go through. The house has to have those things. And with a conventional loan, you can get away with a little bit more. So if you know you're buying a fixer-upper, you're okay with that, you know that you're going to take care of some things after closing, you would definitely have to do a conventional loan or cash, but you would not be able to do an FHA loan. Then you obviously have your VA loan. And a lot of people don't realize that that VA loan can be passed down. So, like, let's say that your grandfather had his VA loan and he's since passed, or, he's not using it. He is able to pass that down to you. So there's different types of loans that you're able to really look at. And then there's an agricultural loan. And with agricultural, the thing of that is you can only use that in certain areas. But a lot of times the USDA loans, you have 100% financing available. And there are different programs that you can work with. But again, this is only in specific areas. So if that's something that you're interested in, you would definitely have to look at that, and we can figure out if the home qualifies for that or not. Anthony, let's see. With multiple offers back on the scene, are you seeing sellers accept fewer concessions? That's a great question. So in some cases, we are. We had a situation recently where we made an offer on a property. The seller had been under contract previously with a buyer that had a home to sell contingency. And unfortunately, that buyer was not able to sell their property in an adequate time to what the seller felt like was a good time limit. And so they ended up terminating that contract. The buyer did. And so the seller went back on the market. So then we came along and we were going to offer, but we did have a home to sell contingency as well. So the seller was really nervous because they had just been burned and they would not accept our offer. Now, where the catch is for that one, we had not even listed the property yet. My clients that were about to list their property had been burned because we had listed the home before, had so many showings, they were not really knowing where they were going to go. And so they got cold feet, backed off, and they were like, we need to find where we're going before we list. Well, now they found where they were going, but they wanted them to list before they could buy. So we ended up listing. We literally turned around, got pictures within 24 hours, listed it 48 hours later, got multiple offers, went under contract, resubmitted our offer. And so that offer did get accepted because we were under contract. So a lot of times, if you have a home to sell, you're going to have to make sure that it's listed and maybe even under contract before a seller is going to accept your offer. Because if you think about it, if you were selling your home and a buyer came along and said, well, I'm going to be listing my house next week, you have no idea how long it's going to take them to sell that home. Because what we're seeing is homes that are move-in ready, look good, not a lot of work to be done. Those homes are flying off the shelves. They're getting multiple offers and they're being taken off the market usually within the first week. If the home needs work or is overpriced, there's one here in Swanee. I won't give you the address because that would be calling that agent out, but I've listed two here in Swanee and they've both gone under contract within a week. Multiple offers at that. This other home that's in Swanee, it's not my listing, has been on the market for about 6 months. Now, when they first listed, they were grossly overpriced. It is a pretty house, but it is dated and it's going to need updating. It is completely move-in ready. There's nothing wrong with the house, but it is dated. And you know that whoever moves in there is going to want to upscale the property. And it's a beautiful property. It's got lots of room. It's got a beautiful backyard. It's in a great location, but it's still overpriced. And so you cannot come into this market thinking, oh, well, the market is strong and it's a seller's market, so I'm going to overprice. That's a horrible strategy. It's a horrible strategy. And if you have a different agent and they tell you that, you have a bad agent, because that is not a good strategy. You still have to price where the market should have it priced, because that's when buyers will take it up and over the market. If you go ahead and list high thinking, oh, well, we're in a great market, then no one's going to carry it. You may lose part of your buyer pool right at the beginning because they think that it's overpriced. So that's something to really consider when you think of listing your home, if that's something that you're thinking of doing this year. Anthony, great question. So going back to the opportunities for buyer assistance. So there's a lot of them, right? And some of them have been around for a long time. Some of them are new, but there's like Georgia Dream, which has been around for a long time. And I know when I first bought when I bought my first home, not when I first bought. When I bought my first home, my husband and I think it was 2009, if I'm right. It's been a really long time. So in 2009, I think, is when we purchased our first home. It was right after the crash. And of course, they were giving out incentives to anybody that would even remotely look at buying a house, because they wanted to stir the market back and get everybody getting back into the buyer pool. And so there was an incentive. They would give you $8,000 toward whatever you needed it for. So they would give it to you towards closing cost, or towards, like, if you ended up closing and you wanted to just keep that money, however you wanted to do it, they were basically giving you $8,000 to just buy a house. And I remember my husband and I were like, heck yeah, $8,000. But then there was a catch. You had to stay in that home for a minimum of 2 years. So you could not sell before that 2 years was up, or you owed them the money back. And you had to have that as your primary residence. So you could not buy a home if you already owned a home and you were trying to buy an investment property, or if you were keeping your existing home as an investment property and then you were buying a new home for yourself, you could not get that $8,000. That was not something that was going to be given to you. This was strictly for, you're buying your first home. The government's trying to help you get in it. And so here's $8,000 to kind of get you going, right? So everything comes with a cost. And that's what a lot of people don't realize. Um, and again, I'm sorry that I cannot share this with you. It's probably boring just seeing my smiling face over and over here, but this stuff is just so good that I can't not share it with you. But I'm going to put everything down in the chat so that you guys can look at it later. But so Georgia Dream is one of the programs. The Gwinnett Home Stretch is one. Federal Home Loan is one that's been around. So, like I said, a couple of these have been around for a while. All of these come with a cost. There is never going to be a program where you are just getting something for free. There's always going to be a catch. So, like I said, the one that I had, you had to stay in the property for a certain amount of time. Otherwise, you owed the full amount back. And so, let's say that you ended up having to move for whatever reason, you got relocated or anything happened in that time frame, you now owe that $8,000 back. So it was kind of a scary thing to take it, because then if something happened and you owed it, you want to make sure that you have that money to give back, because let's face it, y'all, the government does not play when it comes to their money. Our money, it's a different story, but it's a whole nother thing. Anyways, um, it sounds good on paper, but the other thing that I have realized, and I've talked to all of my lenders, I have 2 lenders that I work with regularly, and I trust them very, very much. And I talk with them about these things, especially when we have new home buyers that are coming up, or if we have somebody that's maybe on the lower end of the scale as far as affordability. We will try and come up with anything that can help possibly get somebody into a home, because we never want to stretch them to something that is uncomfortable. It's never worth eating ramen every single day for the rest of your life just so you can get in a home. I promise you. When my husband and I got into our first home, we were fine. And then I had a baby and didn't work for a little while. And boy, oh boy, does that change what your scale looks like. And those ramen noodles all of a sudden taste really, really good. And so don't ever get into a situation that you can't live comfortably. It's okay if you decide, hey, maybe I don't have Starbucks every day, or maybe we're watching our spending as far as going out to eat all the time. But if you're having to stretch yourself really thin, you're spending too much money. You're spending too much money. There are specific debt to income ratios that you should be looking at, and you should either be talking to your financial advisor, or you should be talking to a reputable lender that's going to really look at your debt to income ratios with you. And you should be saying, this is what I'm comfortable with monthly payment wise. And then that lender is going to back you into, okay, so at that amount per month, this is what it looks like for a mortgage. So then you can say $2,000 a month max is what I'm comfortable with. And then the lender can say, okay, Ashley, that $2,000 a month with what they're putting down, we're looking at a $400,000 price point. Great. Now we're all on the same page. You know what you're looking for. The lender knows what you're looking for. I know what you're looking for. But so with these programs, and a lender can tell you, a good lender can tell you, and this is why I preach about lenders so much, is because unfortunately, it's like every job, there's good doctors, there's good lawyers, there's good realtors, there's good lenders, and then there's not. And so a lender is one that is dealing with your money. They are dealing with probably your largest financial investment to date. And so you do not want to play around when it comes to getting your lender. A lender is a very important piece of this puzzle. They're going to be looking at your financials. They're going to be looking at your debt to income ratios. This is a very personal thing. I never get to see your bank statements. I never get to see your financials. Anything that you don't personally share with me, the lender is not allowed to legally share with the realtor at all. So the lender is a very, very important piece of this puzzle. Now, the lender and I work very closely together to make sure that you're getting to closing, that we have an understanding about where price point wise you're going to be purchasing. But I, as your realtor, or any realtor that you come in contact with, they should never see your financials. That's really and truly none of our business. So make sure you shop around for your lender, or if you need a lender and you're thinking about buying or selling, message me, email me, call me, text me. My information is always right there below, and I will put you in contact with them. I get nothing out of that. I get no fee. People are like, oh, well, you get a kickback. No, I don't. That's illegal. And if your realtor is getting a fee, then it's illegal. So all I get out of it is two things. A, I have the peace of mind of knowing you're with someone that's reputable and they're going to do a good job for you and they're not going to try and push you into something that you're not comfortable with. And B, when you go under contract, I am able to stay on top of that lender and make sure that we are meeting our contingency dates because the lender is the one that's ordering the appraisal, who's getting you through underwriting, and those contingencies are part of the offer. And therefore, I'm able to keep in constant contact with that lender, making sure that we are meeting those dates and not missing them. Because if you go with somebody that's online, um, there's Better Mortgage, there's Ally, there's different people that are online. I'm not saying they're bad. All I'm saying is that I have no way of controlling anything with them when it comes to those dates. Um, I am put into a queue just like you are. Bank of America, Wells Fargo, the big banks, their side of things is banking, it's not lending. And so you're put into a queue, you call a 1-800 number and you pray to God that you get somebody. So if I need to hear back from your lender and it's with Bank of America or someone online, I'm sitting here fingers crossed just like you, hoping that they call us back within a reasonable time. Where with local lenders that I know or I have relationships with, I can call in favors or I can call in the trump card of, hey, I'm going to need you to make this happen. And they usually do. So I keep in constant contact with them about these programs. And unfortunately, it's kind of a catch-22 because these programs promise to give you information. They promise to give you assistance as far as financial. But then the catch is a lot of them have fees attached to them. So they're giving you money, but then they're charging you fees on the back end because they can roll that into the mortgage. So it's really tricky because they're basically giving you money, but they're financing it. So you're really not getting anything. You're getting the cash in hand. It's almost like a loan. You're paying it back. You just don't see that you're paying it back because it's rolled into the mortgage. And over 30 years, well, that's just a little trinket here and there, but really and truly, you're not getting anything out of it. Now, if you feel like, you know what, I'm okay with that because that gets me into a home, I get that. I respect that. And if you're in that home for any length of time, you will gain that back in equity. And then when you sell, you probably are not going to keep this home for 30 years. Very few people stay in their home for 30 years, and therefore you would not be paying that full amount back. But you do need to check on each of the programs because a lot of them do have something like if you sell the home before a certain time. I know there was one that they were playing with, but you had to stay in the home for at least 5 years. 5 years isn't a substantial amount of time, but there's a lot that can happen in 5 years. What if you get relocated? What if you have kids and you want to move for schools or whatever? So you really have to look at those things. There is another one that is specifically geared for lower income. The trick to that is, though, you have to make such a low income that you're really only qualified for up to about $150,000. Let's be realistic. $150,000 right now is not going to take you very far in this market. And so it's frustrating because the programs that they offer are geared for lower income. There are a lot of people that make, $50,000 that would qualify for a $300,000 mortgage. In $50,000 a year, where we are right now with wages and with everything going on, that's hard to get qualified and then have your down payment. So I really feel like they should be having some additional incentives, some additional programs that can help people start to get, back into the market if they're not going to lower rates for, certain price points, I guess. Carl, can we use our own bank as our lender? Absolutely. We have clients all the time that if you have a good relationship with your bank, especially if you have a banker that you've banked with for years, absolutely you can use your own bank. If you're with one of the larger banks, Bank of America, Wells Fargo, I do encourage people that you get appointed a certain person with the bank that you can then reach out to and contact instead of having to call that 1-800 number. Or we've had some people recently, they do online banking with Ally. They went through them. Or some people are here local and they have like Quantum Bank, their Pinnacle Bank, smaller banks. So absolutely, you can use your own bank. I always tell people, shop around, talk to your bank, see what you can get as far as an interest rate and what programs they offer, and then talk to a local lender, talk to a credit union, because realistically, it comes down to two things: who's going to give you the best rates and who's going to give you the best customer service. Because we have had some situations where a client went for the better rate, but it wasn't a substantial. It might have been like, 0.002 of a percent, right? So it wasn't a substantial amount. But then we're sitting at the closing table and that lender isn't responding. And it was kind of a deer in the headlights moment, praying that we were going to get to closing. But thankfully, we did. So definitely just making sure that you can do that. Carl's Wells Fargo. Yeah. Definitely. If you have somebody that you've been with and you can connect with them, absolutely. Anthony, hi, Ashley. What's your experience with buyers who have used Rocket Mortgage? Are they better or the same as big banks? Anthony, I don't know that you want to hear my opinion. I have had experiences with Rocket Mortgage. If you are a clean cut file, there is absolutely nothing out of the ordinary. You will probably be fine. They are not the greatest at responding in my experience. And I've had multiple experiences with them. They are not quick to respond. So again, if you're a clean file, you are Johnny on the spot, you're uploading everything that they ask you to upload, you should be fine. Because a lot of times you can get a better rate with them. However, if you are self-employed or 1099, have multiple businesses, anything that is going to be a little bit out of the ordinary, where maybe you need a little bit of a handhold or maybe you need a little bit of guidance on things, they are not going to be a great fit. We had situations where we had to end up pushing closing because they were not getting things done. They weren't exactly sure how to handle some things with a 1099 and owning an own business. So it's definitely one of those things where I hate to say it, but you get what you pay for. And sometimes taking that little bit higher of interest rate with a local lender, and the local lender isn't always higher. That's why I always tell people, don't just have one thing set in your head. If you want to try with Rocket or Better is another one that's online, and I've had a great experience with them. Try them out, talk to them, see what the interest rates are. But also check out a local lender, check out a credit union. There's so many options. And a lot of people don't realize that if you are shopping around all during the same time, they're all going to say, well, we need to pull your credit. As long as you're doing it all at the same time for the same thing as looking for a home, it's not putting a ding on your credit. So get that out of your head. You can absolutely shop around and look at different things. And it's not going to hurt your credit. It's not going to take it down. So I appreciate that, question, Anthony. That's definitely something. And Carl, if you guys need any assistance on that, or you want to talk to different lenders, I also have a credit union that some people here have used. I'm happy to share all of that information with you. You can email me or DM me, text me, whatever works, and I'll get that information over to you guys. So I hope all of this helped today. Like I said, I'll put everything down in the chat. That way you guys can look it over. I'll put the links to some things in there. That way you guys can check it out for yourself. Make sure that you're fact checking, because I tell you to do that with everything that we do on here. I'm unapologetically honest about everything because I'm a realtor. However, I'm also a consumer, and I want to make sure that we're doing what's best for you as the consumer and the economy. So I look forward to seeing you guys next Thursday, same time, 6 o'clock. See you then.